Hello, and welcome to our 2026 Outlook Strategic Insights and Planning webinar. I'm your host today, Adam Farrig, Vice President of Strategic Markets at Oak Street Funding. Joining me today is Rick Dennen, founder and CEO of Oak Street Funding, and Phil Trem, president of MarshBerry. Today, we will be discussing changing lending conditions, evolving valuations, the great wealth transfer, and much more. Gentlemen, thank you for joining me today.
Thanks for having us. This is great.
So nearing the end of 2025 and looking ahead, what economic and market factors do you expect will have the biggest impact on businesses in 2026?
To me, there's just a lot of macroeconomic things going on, but the most important and the largest that I think will impact the M&A market is interest rate cuts. I think that's on everybody's mind. I think the industries that we're in here have probably been least impacted when the market rates increased versus other industries. I think they slowed for about a quarter or two, where I think other industries slowed for more like 12 months. And now with the rates starting to decrease, I think it's going to, continue to allow the M&A industry, the M&A activity to continue. I think the capital coming into this industry is plentiful, and I'm kind of predicting being very bullish for 2026 and predicting a record market.
Appreciate that. Phil, what would you have to add there?
I completely agree. I think the interest rate environment is going to continue to push more and more demand into the market. From a supply perspective, it's going to be interesting, and I know we'll talk about this a little bit later, but the sustained bull market has really heightened concerns amongst RIA business owners around a potential market pullback. And there's a lot of conversation and comparison to yesterday as opposed to a month ago or a year ago or call it even pre-COVID, where we see where the market was. And so when you've got slowing economic growth, persistent inflation, you're seeing a high market. The concern is if the market pulls back and I'm in the middle of a process, how could that potentially impact my value? So there are going to be some supply concerns, not that there's not a need for firms to transact, but, trying to figure out the right moment to time when I go to sell as a business owner or an entrepreneur is going to be something that we have to keep an eye on because the market pushing AUM up and up and up has been great, but then there creates an expectation of I'm worth X today. And in 6 months, if the market pulls back a little bit and I'm worth X minus something, how does that change the psyche of those business owners relative to what they decide to do in 2026 with their business?
Hey, let me tease that out a little bit, because I agree with you, Phil. Do you feel, the comment you just made about, some of the volatility and swings that could potentially occur, that the buyer, whoever the buyer is, will be, a larger buyer, an aggregator, is going to kind of look beyond some of that volatility and know that it's going to exist versus maybe an M&A deal with two parties?
Absolutely. I think the buyers understand and expect it. And we'll talk about drivers to value in the future coming up here. But I think you're right, Rick. It's going to be more about how sellers, what the expectations they create for themselves around their own value. But what buyers tend to do is they'll adjust pricing mid-deal if there is a pullback. So the timing of it, once you're too far, your kind of train's moving on the tracks, you can't stop it. And if we see a pullback, are you in a position where the buyer might decide to try to change the terms because now all of a sudden you're kind of rolling 12, the forward-looking 12 months of your business is slightly smaller than when they originally priced the transaction. So it's a give and take. That can be offset by an RIA's ability to generate net new clients. So if most of the growth historically is coming from market growth, then buyers are more likely to adjust pricing midstream than they would if you've had kind of sustained growth from your ability to attract and retain net new clients, not just getting additional volume from your existing client base or kind of riding the market up. So the fundamentals behind all of that really are going to have an impact. It's not one size fits all.
Yeah. Yeah, I think that's pretty accurate. I mean, having gone through 3 sales ourselves, the experienced buyers weren't as concerned about timing the market. And, if we had a good sales month, for example, that really impacted, it was like, hey, this is a longer term investment and we know this stuff is going to happen. And, if you find a good platform, if you find a good management team with good growth rates, they're going to move forward regardless, without nickel and diming the price so much.
We've seen that quite a bit through even peer-to-peer transactions as well. Folks that are focused on the bigger picture tend to look, more so at the operations in the firm that they're acquiring more so than the market volatility and the recent stuff.
Yep.
So with that, we're going to have some rate cuts in play. How do you guys expect lending conditions and deal activity to shift in the coming year? Rick, I'll go to you here.
As I stated earlier, I think 2026 is a record year. I'm kind of being bold in saying that, but a lot of activity there. I think you've got both from an equity, from a debt side, all the pieces are there. Phil touched on just the strength of the markets right now. Do I think there'll be a pullback sometime in the next, 15 months? Yeah, I think there'll be something, but I don't think it's going to slow down. I don't think it's going to be, a 30% drop, and I think the activity will continue as a result.
Absolutely. Phil, do you have anything to add there?
Completely agree. I think the lower rates could also potentially increase valuations slightly. We're going to see increased cash flows, potentially firms who've got a little bit of room between the leverage they have and the leverage that's allowable by their lending partners. But some firms haven't pulled the trigger to max out that leverage because of the interest rate environment. So if interest rates drop, that may allow them to take on more leverage, which creates more capacity and demand. More demand creates potentially more competition, and as a result, higher valuations. So I completely agreed. We're on track right now to see an all-time high in transactions in the RIA space. We're predicting 400 transactions. 353 was the mark we showed last year. We think we're going to get to 400 in 2025, and we believe 26 could eclipse 25. Just considerable amount of capacity. Another statistic just to consider. Through September of this year, we tracked 60 private equity-backed RIAs that made at least one acquisition. So think about that. 60 firms that have private equity investment that have done at least one acquisition. And that's a staggering number when you think about how many firms are in the market acquiring right now and how many more firms could be taking on private capital to flood the market with even more demand in the coming, 3 months or 15 months. So demand will continue to outpace supply, but because there are so many options, I think the availability of capital and the cost of capital decreasing is going to continue to press more and more value and volume into the marketplace.
Got it.
Do you have a feel, Phil, for a similar statistic around the insurance space? The number of private equity-backed insurance platforms, kind of at this stage of the cycle, I have to guess that 60 is 2 times what it was in the insurance industry when that started kind of going through consolidation.
It would be anecdotal, Rick. I think today there's probably 45 to 50 private equity-backed brokers, but obviously in the insurance space, and that space, that industry is a little bit more mature relative to the pace of acquisition. You're probably right. I would say that there's probably half that number if we were to match up where the markets are in their different cycles. And it's interesting though, because even in the insurance space, while it's, I would say, more mature relative to its M&A activity, we're still seeing new private equity or private sponsored backed insurance brokers popping up out of nowhere, even yet today. So it's not happening as fast as it is in the RIA space because it is a little bit more mature, but it is not, we're not seeing a shrinking of insurance, private equity backed insurance brokers either.
Perfect. And so, Phil, you touched on the valuation side, so that kind of brings us into our next question here. And how do you see valuations evolving across insurance, CPA, and RIA firms as consolidation and private equity activity grow amongst those industries?
Yep, it's interesting. Again, all three of those industries are in very different stages. I'd say kind of the newest is the CPA space, where we're just starting to see private equity over the last couple of years get into that industry, and it's becoming a bit of a fast and furious pace of consolidation. Then we've got the RIA space, which is a little bit further ahead of the CPA space, and insurance is probably 5 to 7 years ahead of the RIA industry. Valuations generally, though, don't necessarily always make absolute sense. And everyone's trying to figure out what are the drivers. In the insurance industry, everyone's tracking the public broker valuations as a litmus. And I think it's getting really dynamic in the insurance space, where public broker valuations really impact private equity-backed broker valuations, but they don't really impact as much independent entrepreneurial-led valuations, because pure supply and demand is what's really driving valuation at that level. So when we see fluctuation in the publicly traded and private equity backed valuations, there isn't immediately a direct correlation to increase or decrease in value to your standard independent insurance agency or broker. So it's a little bit a unique dynamic. What we're seeing in the insurance space over the last 3.5 years is we've hit a high watermark, and it's been we're calling it a plateau, because it's not a peak. We aren't seeing the top and then coming down the mountain. We've hit that high watermark and we're holding. And so valuations, for independent brokers and agents has been holding for almost the better part of 3 years. We're starting to see some interesting dynamics within insurance and the RIA space, though, where while valuations are at all-time highs, on an average basis, they're holding. But if you look one layer below, we're actually seeing slight increases for the best performers in both industries, which is really being driven by those that are growing outside of market influence. So in insurance, if you're able to grow organically, consistently above rate impact or exposure-based growth, you're worth more than your peer who's just growing because of the tailwinds behind them. In the RIA space, if you're able to bring on net new clients on a consistent basis, and you're not just growing because the market is growing, you're worth more, significantly more in some instances, while we're actually seeing valuations pull back a little bit for those that's growth is being really sustained by the market. And because as we're seeing markets slow down or pull back in those two respective industries, the concern is the sustainability of the historic growth they've had over the last 3 or 4 years. So they're still worth a lot relative to historical kind of references, but they're not worth as much as they were. So averages are holding, but there's beginning to be more of a bifurcation between those that can truly drive organic growth and those that are growing because of the tailwinds behind.
Got it. Rick, what are your thoughts about the valuation?
I mean, Phil said it extremely well, but the only thing I really want to add is I think those plateaus are the same exact thing is going to happen in the less developed industries of, RIAs and CPAs. And I think they're going to get to the same levels. The same criteria is going to impact those valuations both up and down. And, they'll hit that plateau and level out. And I think it's going to be there because there's so much capital coming.
Got it. Now, I'm going to throw in an extra question here, too, around that. But do you guys see deal structures impacted by the changes in valuation across the industries? How much capital up front, how much contingent, things like that?
I don't see it changing. I see the credit funds changing the structures and pushing the structures more.
Okay.
Than the valuation change or things like that. I frankly think those credit funds are going to allow for maybe, call it an extra half turn on the multiple because of their aggressiveness and the way that they're going to allow leverage to play out, with these acquisitions.
Got it. Okay. Good deal. So for business owners considering a deal, what signals should they look for to know the timing's right to either buy, sell, or engage a partner? Phil, I'll start with you there.
I love this question. For a business owner of an RIA, they should follow the advice they give their clients and not try to time the market. It's incredible how many business owners try to time the market relative to where their revenues are. The most attractive sellers from a buyer's lens are the ones that have a business strategy that they've been executing on and have come to a conclusion that partnering with a capital provider, selling to a strategic partner is what's the right next step for them to continue to accelerate their business, as opposed to it being viewed as an exit strategy. And buying can be viewed the same way. Why am I acquiring an organization? Hopefully it's because I view it as complementary to the business that I've built, as opposed to trying to mask my inability to grow organically on my own. So we really believe that as a firm steps back in any of these three industries, they should be taking a step and saying, what does the next 3 to 5 years look like for our organization? What do we need to continue to be successful, to attract and retain talent, to attract and retain great clients? And we either build those things on our own, or we partner or sell to someone who can help provide those things. But if your view of timing the market to sell your business is to be your exit strategy, you're already taking a significant discount to what your valuation would be, as if you're looking for a partner to join and a partner to continue to help you scale. So the mindset needs to be different from, I want to time this to maximize value, to how does this help maximize the business opportunity, and value will follow.
That's great. I think finding the right partner through that process is why it's so important, and not just trying to time the market for the best valuation. So would you have anything to add there, Rick?
Yeah, I agree with Phil again. I think the only additional thing to add is just the psychology around the sellers exiting. Okay. And I think they feel sometimes that, hey, I'm ready to sell. And when it comes right down to it, mentally, they're not prepared to turn it over to, somebody else to lead the organization. They're the founder, they've been the driver of growth for 20, 30 years, whatever it may be, and that's their pure identity. And sometimes those leaders, they're tough to get out of the seat and turn things over when they really need to. And, that can impact the timing as well. If they just continue to drag it out, they sometimes just need to move out and really build a solid succession plan in place that's going to carry on the legacy that they've really created.
Yeah, and continue to fuel growth, right? Yeah. With the right partners. So moving on, as firms compete for growth, everybody's competing right now. How important is niche specialization going to be in standing out and winning new clients in 2026? I'll start with you, Rick.
We've said this as far as our business and lending. I'd rather be an inch wide and a mile deep. I want tremendous expertise. I want the ability to differentiate. And there's a quote I always remember from Jack Welch, who said, if you can't compete, don't. You know what I mean? And you think about that in relative to banking. I think there's 43 banks here in Indianapolis. How do you differentiate yourself? Do you have to compete against 43 banks every single time? But if you have an expertise, in an industry or a product, I think that gives you a clear advantage of being able to get those opportunities as they're created.
Makes a lot of sense. Phil, do you have some thoughts there?
Absolutely. I mean, I think segmentation makes a ton of sense, particularly in the RIA world. There's a lot of different types of clients, and understanding what the target market is and serving that target market kind of with excellence is really important. And it'll help you continue to attract ideal clients. There's a ton of referral business that comes through when in a people-based business like this through referrals. So it's hard to be an RIA and focus on mass affluent and ultra high net worth at the same time. They have different needs. They have different solutions. Having a service team that's trying to service all people the same way when they have different wants and needs and expectations is really challenging. So figuring out your client segmentation and to Rick's point, being really, really, really good at it, it is super powerful. And what we're starting to see with a lot of the larger national firms is that they're pretty much sticking to their knitting as well. There's not a lot of firms that are trying to serve all of the different kind of target markets from a clientele perspective. And that's kind of really, for lack of a better word, that's highlighted by the fact that you can see a private equity firm own 3 different RIAs because they don't compete with each other, because they have 3 different target client segments or 3 different target markets.
Right.
You don't see that much in insurance, and you're not going to see that much in the CPA space, where they can have, multiple investments that are in the same geographic markets, because they're all going to end up competing with one another. But in the RIA world, if the target markets are different, then you can have those different levels of investment. And I think that's a testament of what entrepreneurial independent RIAs should continue to focus on, is what are they good at, and how do they get as deep as possible into it?
Exactly. Don't try to be everything to everybody. Focus on what you're good at, invest in those resources, grow that business. Makes a ton of sense. So we're going to transition to the great wealth transfer. So the great wealth transfer is underway. How should RIAs prepare to attract and serve younger generations of investors and clients? I'll start with you there, Rick.
I think that's a great question, and one that can have a tremendous impact on value for those founders. But, to me, I think they got to think about it long in advance, like succession, and they got to translate that to the other side. So having a good bench of quality people underneath you that can learn, so that while you're dealing with the family founder, maybe, or the patriarch of the family, as his children come through, you can create introductions with people on your staff or on your bench, and they can start developing relationships and transition this in order to keep some of that wealth within the organization. There's so many opportunities to go to a new place, and as that family or the customer starts changing geographically, and they come up through schools and they have their own relationships, there's going to be a real challenge to move that book somewhere else. And if they don't have a relationship in place with good value-added services, I think it's going to be harder to retain those customers.
Perfect. What are your thoughts there, Phil? Next
Completely agree. Completely agree. We're seeing firms transition to a much more team-based approach to advice, trying to allow clients to connect with advisors who are closer to their own stage of life, which we think strengthens the personal and professional relatability. People tend to choose advisors they can relate to. So in a people-based industry, having a diverse team or building a diverse team that can mirror your clients' demographics or the next generation is super valuable. We are seeing some firms try to focus on the kind of intergenerational relationship, which is really saying we're offering family meetings, we're having these kind of legacy planning sessions, but it's not just the advisor with gray hair in the room. It's that team-based approach with the team, with the whole family dynamic. One other trend that we're starting to see, however, which I think is interesting, is that there's statistics out right now about a growing share of wealth shifting to women as heads of household, yet women remain incredibly underrepresented in the advisor ranks. And firms that can figure out how to address that imbalance, I think, can really meaningfully differentiate themselves. Again, trying to match the advisor to the demographic of today and tomorrow's future client base. So it comes back down to people. It always has been, and it will continue to be, that if you can't connect and relate with your future clients or your soon to be new clients, hopefully, they won't be your clients for long.
Yeah, that makes a ton of sense, Phil. So I'm going to go back to you with this one, Phil, but how do you see tech and AI shaping how businesses operate, how they scale, and how they compete in 2026?
Yep. AI continues to be interesting. Technology generally, and I would think AI as well, is still being focused on, and I think will forever be an amplification and not a replacement of the advisor-client relationship. The same can be said in the insurance side. it's not going to be a disintermediation of the relationship that individuals have. It's still going to be a human connection, human connectivity type of industry. But there are ways to leverage technology that firms are finding to enhance the engagement, to create a more personalized engagement, and behind the scenes create incredible efficiencies. We do believe in both the insurance and the RIA space that margins for these business owners are going to continue to grow. Now, maybe there'll be fee compression at the top, so revenues will be harder to obtain, but the expense structure that it takes to run and operate these businesses are going to become more efficient, creating additional capacity. And the firms that are going to end up winning or finding themselves at the top are the ones that are leveraging technology to create capacity and redirecting that capacity to more direct human interaction. So it's an interesting balance where we don't want AI and technology to replace the role of the advisor or the broker, but to create the right leverage within the way they work and using that additional time and capacity to either bring in new clients or find better touch points and engagement with your existing. So it's going to be interesting to see how people adopt this and whether they repurpose this newfound time and capacity to actually create stronger human connections.
Makes sense. And so, Rick, obviously you've got experience starting and growing a business, ultimately leading it through a transition and sale multiple times. How do you see tech, and AI coming into business and shaping how businesses operate and scale?
Look, money is at the forefront of a lot of people's mind. And I don't think, just like Phil said, it's a relationship. I do think this younger generation, having 3 boys with, I would say, lesser business patience than, maybe the older generation. I think you can get on ChatGPT and say, this is the amount, this is my age, this is how much I make, this is how much I live, this is how much I want to save, create a financial plan, and it's going to be there. And you can go to, a cheap platform and just execute on that strategy. I do think there's going to be some of the population that's going to go down that path. But the higher the wealth, the higher net worth individuals wants that relationship. They want the validation, and it's a multifaceted plan from, tax planning to philanthropy to trusts and estates. And there's just so much to it that I think that would be very hard to just simply do with an AI type, approach. So I think it's going to be a challenge. The key thing I think in the question is I'm not so much concerned about it in 2026. That's going to play out over a long period of time. And if you think about, 15, 20 years ago, I'm probably the only one old enough to say it. Phil's not old enough yet, but, everybody said the internet was going to change how insurance was purchased. Okay. I think some of the commodity products, yeah, they have been able to go to an electronic platform to be able to sell. But, your commercial complicated products, that's still a relationship, and that's what exists. So it's, AI is really dynamic and neat what it can do for you. But I think your higher net worth people are going to go beyond that and need that relationship. And I think the companies, providing that advice will also be able to use AI to put together better plans, more sophisticated plans for their customers.
Yeah. So what I'm hearing here from both of you guys is, AI used as an enhancement to services offered to clients, but, ultimately there's a relationship there that it comes with doing business. And so it kind of takes us into our next question here, but talent is a huge challenge for firms across all industries, and especially in the wealth management space. We talk about a talent war. So, what challenges do you guys expect around recruiting and retaining that top talent, and how can businesses overcome those challenges? So, Rick, I'll start with you here.
Talent has always been our most important thing here, our most important asset. We have said that, even saying it's more important than the customer, because if we don't have talented employees, we're not going to have great customers and great customer service. So But they go hand in hand, obviously. As you see these businesses, and I've actually sat on a couple of boards during transition and succession, you've got incredible talent at these companies with no ownership stake. And they're being paid at W-2, which makes it really easy for somebody else to pick them off and to offer them and see that talent and offer them, restricted shares that's going to tie them in and really ingrain them in the organization. And I just think people sometimes become a little short-sighted in when they're offering restricted shares to be able to create that alignment. And when they do, it creates a tremendous ease in the tension of succession in the organization, and people go out, and we've seen a lot of growth as a result.
Yeah, it makes a ton of sense. Phil, what are your thoughts about talent retention and recruiting?
Yeah, within the RIA world and the insurance brokerage space, it's one and the same. I mean, uniquely different, but very similar. And Rick, you used the term succession. It's interesting. We're seeing a lot of firms with the just increased M&A activity in both industries. We're seeing fewer and fewer and fewer firms talk about succession or agency or RIA perpetuation, which used to be, are we going to, in the RIA world, are we going to give it, sell this to G2 or G3? We hear less and less and less of that, and more about a pathway to partnership that's more about attracting and retaining people than it is about, I want to turn this business over to the next generation of employees and leaders. So it's been a bit of a shift from within our organization. We're being hired less and less to do full perpetuation plans and succession plans, and more, how do we create incentives around comp and equity participation to help drive some shared success? How do we kind of create that hook, not only to attract them, but then to keep them? So a pathway to partnership for the next generation of top performers. And it becomes this idea that, would you rather own 100% of a grape or 70% of a watermelon, right? You have to believe that the people you're offering this partnership to are going to help scale your business. So your retained ownership, even though not 100%, is significantly greater than it would be had you not brought them into the mix. So it starts with hiring the right people, but both industries have been, filled with hollow and empty promises of, I'm going to make you a partner, I'm going to bring you into the mix, and then no follow through. And the firms that we're seeing become more and more high growth are the ones that are willing to create that optionality, to Rick's point, being more than just a W-2 employee, which creates not only restrictive covenants that kind of forces them to stay in many cases, right? It protects the overall business, but creates wealth creation opportunity that, frankly, we see firms, individuals working harder because they see not just the paycheck they're getting, but the true wealth creation opportunity that they've helped create for themselves.
Yeah. I've heard the piece of pie in the pie. I haven't heard the grape and the watermelon before, Phil, but I'm going to start using it if you're okay with that.
Please do. I stole it from someone else, so I can't even take credit. Borrowed.
All right, guys. So we're going to wrap up here. We've talked about a lot of things here, but, most importantly, looking ahead, what are we going to leave our viewers with here? What steps should business leaders be taking right now to position themselves for long-term success going forward? Rick, I'll start with you.
We've talked about them, I think, with all these questions, to be quite honest with you. It's investing in people, getting the right people, giving them ownership. It's technology. It's the platforms. It's running your business the right way with long-term strategic decisions always on your mind. And I think if you do that, the opportunities are going to be there, such that you're going to get multiple, having multiple opportunities or multiple people to exit to, I think will create your highest, value. And, MarshBerry, I know they do the same thing. You guys just went through a transaction, and you guys run your business the right way every single day and invest in your people and things like that. And when you do, good things happen. You don't have to worry about, I need to sell this in the fourth quarter of 2025 because interest rates are going to be at the perfect time and the markets are going to be X, Y, and Z. It's just, run your business the right way every day. In my opinion, good things will happen.
Great. Phil, you have anything to add there?
Yeah, absolutely. Again, really, really well said. I think what we tend to find with independent entrepreneurial businesses is that they get caught in the whirlwind of the day to day of running their business, and a lot of times the CEO, the majority owner, is a great salesperson who's built an incredible business off of that kind of sales engine that they've developed. And in many cases, many of them are really good business people. They just don't have the time or the need in some instances to step back and know, to Rick's point, what does it look like to build and run a good business? A lot of firms live by a budget, or I want to grow 2%. We've met firms that have said we measure whether we're successful if there's more money in the bank at the end of the year than there was in the beginning. And for some, that's okay. It's simplistic, but it's a good measurement. So what we've done with our business, what we see a lot of really successful firms do, is to have a plan and build with intentionality as opposed to inertia. And because of the recurring revenue in the RIA space and in the insurance brokerage space, inertia is actually the default that people can rely on because there tends to be growth that happens all the time. So if you really lean in and focus on what it is you're trying to accomplish, step back and build a 3 to 5 year strategy. And when you're thinking about making investments, if you're thinking about the hiring you need to do, right, it forces you to think a little bit differently. Instead of day to day, you're thinking quarter to quarter or year to year based on, if I want to be double in the next 5 years, I have to grow 15% a year. How am I going to do that when in the last 5 years I've only grown 8%? Right. So what are the things that I have to change? Business owners don't always step back and think that way unless they lock themselves in a room and force the building of that strategy. And it doesn't have to be a giant blueprint, but you don't just build a house by going to the Home Depot and buying a bunch of lumber and a hammer and nails and start banging things together. You get a blueprint, right? You build a blueprint and then you execute on that blueprint. And it's not complicated, right? Hire us, hire someone else, doesn't matter, but take the time to do it. It is the single most important thing I think a business can do, particularly an independent business, because when you go back to timing the market, it gives you the opportunity to step back and think about, what are the constructive hurdles I have to overcome or the investments that I have to make in order to accomplish my goals? And can I do that, or am I willing to do it on my own? Because a lot of times when people step back and say, this is what I have to do over the next 5 years to accomplish my goals, while it's possible, they maybe don't want to go at it alone anymore. And that's a key driver of why there's continued M&A activity, why the supply happens, because I've been working really hard for the last 25 years. I'm happy to keep working hard, but maybe it's time to join someone and do it together as opposed to being on my own anymore. But without the vision of what's next, it's hard to level set where you should go or how you should time things. So I think it's, give yourself the opportunity to build that business strategy, agree with other key leaders in your business what the next 3 to 5 years looks like, and a lot of good will come of that.
Got it. All right, gentlemen, I want to thank you guys both for being here today, sharing your insights with our audience. And thank you to those who tuned in and submitted questions today. We appreciate your continued viewership. Stay tuned for more from us here at Oak Street Funding with new content and new guests. Thanks again.